How can you capitalize on these massive growth trends in cloud computing without so much risk? I'm going to show you the world's #1 growth ETF. Stay tuned to find out what it is. You've seen these stocks make massive runs, whether it be TWLO or DDOG or FSLY, up 20, 30, 40% in a couple of days. And you've got FOMO, you've got fear of missing out. And that's why you're here. And I've got people even that follow my group and my Facebook group, my channel, that say, hey, I want to capitalize on all these cloud computing opportunities, but I don't want to own 20, 30, 40 individual stocks. This ETF is your answer. 52 holdings. Wait till you see what's in this thing. Stay tuned. Okay, guys, so I could not be more excited to share this than I am right now. Seriously, I had to get this video out. So this is the Wisdomtree Cloud Computing Fund. Now, I wanted to take a second for the followers that have been following the page, that have been following the YouTube channel. They know that I like SKY and I like ARK ETFs, okay? And I also like QQQ. I still like those ETFs. This is a complementary ETF, and I think that once you see what's in it, you're really going to like it as well. It really plays the hot trends right now in cloud computing, and they actually complement each other quite well. So stay tuned, because you're going to want to see, I'm actually going to show you the exact holdings that are inside of this ETF. So do stay tuned for that. I'm going to go through this Q1 2020 presentation for the ETF from Wisdomtree, and I'm going to cover some of the highlights. So stay tuned and check this out. So what is cloud computing? Obviously, you guys know what cloud computing is, right? But it allows on-demand access to centralized information, IT, via a secure network connection. And you've got SaaS, you've got PaaS, and you've got infrastructure as a service. So there's different types of plays. When you think of infrastructure as a service, Amazon Web Services, Microsoft Azure, where you actually can take an on-prem license and host it in a cloud environment. A lot of times they call that a lift and shift. There's platform as a service, like, for example, Google App Engine, where it's provided over a network connection. And then more predominantly, you're going to see, SaaS, so software as a service, things like Salesforce. But these companies that we're going to focus on here are going to be more of the up-and-comers, and there's a lot of growth potential. How does the cloud look? So cloud versus on-prem. So you think of on-prem, you're thinking about having the database at your office, and everything at, having a data center physically at your office. So a lot of you have probably worked in offices where you have a room that's full of servers and IT equipment. Everything is hosted on-prem. It's becoming more and more where you're actually subbing that out. You're doing managed services, having other people manage that data off-site in a different location, what they call the cloud. So cloud versus traditional companies, the key differentiator of SaaS businesses versus traditional software companies is that the revenue shifts from a large upfront transaction to a recurring revenue model. So think subscription models. This is key, and it's why a lot of these companies have done so well and why they continue to perform well with their stocks. You look at SaaS, you got things like Adobe. We'll cover more on Adobe here in a minute. Viva, Shopify, all these SaaS plays right here on the left are ones that I already own, that I've been telling you about for a long time. When you think traditional software, you can think of SAP, even a lot of Oracle, IBM, Symantec, things like that. So what do cloud companies do? There's a few examples. So on the top left-hand side, you've got things like ServiceNow, which is one of my favorites. They do teamwork and collaboration and data storage. On the top right, you got things for software development like TWLO, New Relic. TWLO has been on fire. Bottom left, Blackline. I just did a video on Blackline. It's actually the last video I did. And so we're talking about reporting, accounting, and compliance. And then the bottom right, you've got education and training. So things like 2U and Pluralsight. And we think of education, it's right now on a path of disruption where the ways in which students engage with educators needs to be more than just classrooms. People are learning from home, and that's going to become more and more the norm. Cloud computing revenue model, we're talking about retention, large addressable markets, and efficiency. More transparency and performance and profitability and cash flow allows companies to adapt and build scale with less risk. So they know exactly what they're paying for their subscription, for their services every single month, every single year. And it's very easy for them to understand, what the cost of capital is. And the recurring revenue streams. So it's derived from a subscription or use-based business model. And that's more and more popular, and that's where you're going to see a lot of the stock performance. Potential advantages of cloud versus traditional software. So business model advantages, it's more predictable. Annuity-like revenue, lower R&D costs, higher customer retention, things like that. Product advantages, you can deploy software via cloud, allows to install the updates quickly, more efficiently at scale, and easily expand to foreign markets and have service delivery. Things can happen 24/7 around the clock when you're in the cloud. So you think of revenue forecast, so you can see the growth that's already happened historically from 2018 to 2019. Of course, we're in 2020. You know, the red is the cloud application services, so you're thinking SaaS. The orange color there is cloud management and security services. The light blue is cloud system infrastructure services. That's IaaS. And then the cloud application infrastructure services is the PaaS. And you can see where the growth, all of them are going to have growth, but look at the top on the red, going from 86 in billions of dollars to 100, 116, 133, 151. That's what we want to see as investors. We want to see the opportunity for revenue in the forecast. So cloud's market potential is driven by increasing cloud adoption and the shift from traditional IT solutions to cloud-based solutions. This whole stay-at-home economy has accelerated that tremendously. Increased cloud adoption can lead to significant increase in revenue, with SaaS being responsible for the largest revenue share in the cloud market, and infrastructure as a service demonstrating the highest rates from 2018 to 2019. So you can see there, that's a pretty good chart. Cloud computing as an investment opportunity. Okay, so why do you want to invest in cloud computing? If you're new to the channel and you haven't watched the other videos, you might not understand what we're talking about here and what the opportunity is. So software and services is now the largest industry group within the S&P 500. You probably already knew that. It comprises of $3.2 trillion in market cap and 14% of the index's weight. There are several mega cap cloud-based software companies already in the S&P, like Adobe, but there are many smaller and emerging companies. That's what we're going to focus on here with this ETF that are not currently included in the benchmark index. So what are they saying there? They're saying that those smaller companies that we're talking about, the things like FSLY that I've been telling you about since 2019 on the IPO. In fact, 2 weeks ago before earnings, I said FSLY would be a $50 stock in a couple of years. It went from 25 to high 30s, literally, overnight. So that thing ran 50% in a couple of days. And we're looking at companies like that will eventually grow into the S&P 500. So Adobe did the same thing, and a lot of these other companies like the DataDogs and the FSLYs, a lot of those are going to do the same thing with time as revenue grows and as they continue to win. Measures of cloud success. So these are the 5 C's of cloud finance: committed annual recurring revenue, cash flow, customer acquisition costs, CAC, you'll see that a lot, see that in my job a lot, customer lifetime value, and churn, okay? Those are the C's. This is pretty cool too. So resilient cloud leaders operate with grit. So what are we talking about when we say grit? We're doing a grit score. So the G is for growth, the R for retention, I is in the bank, T is target spend, and that gives you your grit score. So on the bottom left, we're looking at year-over-year growth in annual recurring revenue. A baseline measure, they're looking 50 to 200%, massive. Percentage of annual client net retention, you want between 80 and 150%. Years of cash on the balance sheet, you want 1 to 3 years. Obviously, more the better. Spending efficiency score. This is a measure of revenue growth relative to cash spend. Overspending to achieve top line growth is not sustainable, so you want that to be 0.5 to 1.5x. So the good scores will be between 3 and 4. The better scores will be between 4 and 6, and the best are above 6. Now, a lot of you voted for the next video and you want to know how I pick my growth companies. I do a model similar to this, and I promise that I at some point will make a video to explain how I pick my individual stocks. This video today is focused on an ETF, and you'll actually see when I show you the holdings that almost every single stock that's in this ETF I already own. And if you don't want to guess, and I've had people in the Fired Up Wealth group say, I don't want to own 50 different stocks to try to cover this, this sector or this, growth opportunity. This is your ETF. Sky will complement this, but Sky has a lot more of the large companies that have already grown So you think of Facebook, not Facebook, but you think of Amazon, you think of Microsoft, you think of those type of companies. Those are in Sky. They're not in this ETF. So stay tuned. I will show you every single stock in this ETF. But this is good information. So even if you understand cloud and you've followed the channel for a while, if you really want to understand this industry, this is very good information to listen to. So stay tuned. So the Nasdaq Emerging Cloud Index is what this ETF is focused on. And so I'm not going to read through all this. The biggest thing, annual revenue growth. They want at least 15% at least in the last 2 full fiscal years for new additions, and 7% in at least one of the last 2 fiscal years for current securities. And there are other things like has to have a minimum market cap of 500 million. They want a minimum 3-month average daily dollar trading volume of 5 million. So you need to have liquidity. You don't want to find a stock that nobody's buying or selling because they want liquidity. And things like it may not be issued by an issuer that's in bankruptcy. Some of this is very obvious, but this here is what this ETF is going to cover. What the focus is the Emerging Cloud Index, and here's all the different parameters they look at when they're choosing stocks to go into their basket of holdings. Combined expertise from Nasdaq. So I won't go through this too much, but basically on the left here, leading venture capital firm in the cloud computing space. There's 22 initial public offerings, 49 mergers, 150 cloud leaders. And then on the Nasdaq side, a long established history of creating indexes. So they're just trying to, show you the value in historic returns and things like that. Wisdom Cloud. So this is the Wisdom Cloud Computing Fund. The ticker is WCLD. So W for Wisdomtree and then CLD for cloud. You can see the weighted average trailing month revenue growth. You can see that on the blue here. This is WCLD 38% versus the S&P index at 8.3%. So if you want growth, these are the companies that are going to give you growth in your portfolio. They're going to have the highest risk and the highest reward. They're going to go up and down. They're called high flyers. Weighted average trailing 12-month gross margin, 70% gross margin on the WCLD versus 48%. The cash flow now, on the other hand, is going to be a negative. The WCLD has an 8.1% versus the S&P index of 18.9%. So almost 10% more when you're looking at the weighted average trailing 12-month free cash flow margin. And then the weighted average trailing 12-month efficiency score, WCLD at 46%, where the S&P 500 index at 27.2%. So here's WCLD valuation versus sales growth. This is really important. So pay attention for this slide. Sales growth plays a significant role in driving WCLD's valuation. WCLD's weighted score, or weighted average sales growth, was 38% over 12 months trailing. Sales growth for the S&P in comparison was only 8.3%. So this is 30% more. The S&P Software and Services Index gave you 20%, but it's still almost 20 percentage points below WCLD. These are the ultra high flyers. So you don't have the mega caps in here. You've got the smaller companies that want to be the big boys, that want to grow into larger companies. WCLD is currently valued at 8 times trailing 12-month sales, while the S&P 500 growth indexes are 1.9, 3.4x, and 2.5 respectively. So expensive. It's expensive. You're paying for growth. Now, this is a very, very good chart here. It shows you here, WCLD is way on the right? And you're looking at the S&P is kind of over here. The S&P 500 index is over here. So the S&P growth index is still way over here in the red. And then the S&P software and services is still way down here, almost 20% lower than WCLD. This is mega growth in an ETF. This ETF's only been around since September of 2019, so it's not very old. If it would have been around sooner, I would have been investing in it sooner. So here's a couple of the profiles, and a lot of these companies have changed in terms of what's in the index and also the percentages, because it isn't equal weighted, and they rebalance twice a year. So right now, if you look and see what's in there, FSLY actually is the number one holding because the value has increased so much that the weight is higher. They're going to need to trim that and get it back to, I think 2.5% is what they keep all of them at. So mega cap, you got Adobe, mid cap Box, small cap Yext. I did a video on Yext last year. It was called the Artificial Intelligence Under the Radar Stock Picks. There was 5 of them. It was like Splunk and Yext and Viva Systems and Zillow, and there some good companies. Cloud companies. So here we go. Work from home beneficiaries. Okay, this is what you've been hearing over and over and over again. So beginning in the first quarter of 2020, the coronavirus pandemic forced us to reevaluate tools that enable remote working. Okay. Now this ETF, the Wcld, provides exposure to companies that aid businesses. So you think of Zoom Video, Slack, DocuSign, Dropbox, PayPal. These are all the stocks that everybody's telling you to buy, but all in one ETF. This trend toward operating in the cloud is leading to fast revenue growth rates and outperformance for cloud technology. This pandemic basically accelerated what was going to happen. It might have taken 5 years. It took 5 weeks. I mean, no joke, guys. That's what happened here. As companies look to get back to work, we believe cost-saving efficiencies like the adoption of cloud-based software will accelerate. So these have already made a big run, but this is saying that they think that there's still a lot of room for growth and that these companies are going to continue to outperform. If you're interested in this, there's a quick case study in Adobe. The thing I want to drive home on this is that up until 2013, Adobe was basically doing on-premise software. So they'd sell you a CD, you would install it into your computer, you paid for a license, you could sometimes share the CD with other people, whatever. You paid $100 for the CD, and it was good forever. Now what they've done is they've gone from Photoshop, Creative Suite. In 2013, they migrated their product to a cloud-based delivery model, a subscription model. And that translated from a one-time price, like I was saying, here's $1,800 for this software, to a recurring monthly revenue stream. Now, it's more money for Adobe. It's more consistency. They have better insight into their business. There's not these ups and downs with sales because it's just a constant revenue stream. And they're going to get more money for it almost every time because people are going to end up paying more than what the $1,800 was if they keep it and pay month to month. And Adobe will make additional services or tweaks to the software, enhance it, et cetera. And the client likes it, or the business likes it, the customer likes it, because now instead of paying $1,800 up front, they only have to pay $50 a month, and they think they're getting a better deal or whatever, $100 a month or whatever the cost is. So it's less capital up front, which CIOs and business owners love because they also can see exactly what the cost is going to be every single month. So while this transition was very painful, if you remember, they accelerated their growth from less than 10% to 16% plus in 2015. And now Adobe has been crushing it. You can see from 2009, you can see basically the revenue trend in 10 years. It's completely insane. Revenue growth, 22%, gross margin, 84%, free cash flow margin, 37%, efficiency, 60%. Here's a case study on Box, kind of the same deal. The SaaS model now is a 97% recurring revenue. Not going to go through that in too much detail. Yext, it's been around since 2006. They do online brand management, helps companies manage their public facts across popular channels. Like if you Google a channel, clients pay an annual recurring fee to receive these services from Yext. And the revenue comes from continued growth of their customer base and higher revenue from existing customers, primarily due to expanding their subscriptions. You can see they've gone from 2015 in 60 all the way up to 299 in 2020. So what are the key takeaways? And stay tuned because I'm going to show you all the actual stocks that are owned in this ETF. It's amazing. Wait till you see it. Key takeaways. Cloud computing represents one of the fastest growing and most profitable segments in the technology sector. When you think of cloud-based strategies, it represents a higher beta on tech. So this is going to give you a higher return. It's got a higher growth potential than, say, if you just want to go invest in, Microsoft or Amazon. Those are great companies, but they're not going to give you growth anything like the companies that we're going to talk about on this list. By focusing on fundamentals like growth revenue, Wcld seeks to provide exposure to the fastest growing cloud software companies. Okay. So this is going to show you the top 10 holdings, but this is completely wrong. So don't even pay attention to this. All these companies are in the basket into the ETF, but the weights are all completely different because of rebalancing and, stocks performing better than others. What I really want to focus on here is the expense ratio is only 0.45. And if you'll remember, the SKY is, I believe it's 0.6. So this is one of the less expensive, for an enhanced management ETF. It's actually a very good expense ratio. It's an open-end ETF. Exposure is U.S. listed companies that focus primarily on cloud software and services, and they do semi-annual or rebalancing twice per year. Stay tuned, and we're going to take a look at what is inside this ETF. Okay, guys, thanks for your patience. This is what you're waiting for. We're going to get and dive into the stock holdings of this ETF. So before I do that, let's just read again what the actual point of this ETF is. And there's an important message I want you to hear again before I go through the different holdings. So Wisdomtree Cloud Computing Fund, it seeks to track the price and yield performance before fees and expenses of the BVP Nasdaq Emerging Cloud Index. They're equally weighted, usually it's 2.5%. So each stock is about 2.5% of the overall portfolio. And this index is designed to measure the performance of emerging cloud companies focused on delivering cloud-based software to customers. Wcld, gain target exposure to emerging fast-growing U.S. listed companies, including ADRs, that are primarily focused on cloud software and services. This is what I want you to take away. This ETF, WCLD, is used to replace or complement growth-oriented and technology sector investment strategies. I use it to complement or enhance my existing growth strategy. It is not designed to replace everything else that we've talked about with the Qs and with the Skies and all those different things. So think of this, instead of going out and buying DataDog and FSLY and Zoom, all individual stocks, you're going to buy this ETF if you want to play it that way. It's used to satisfy demand for prospective high growth companies with the potential for better sales growth, margin, and operating leverage. Okay, so let's get into this. One thing I will say about this ETF is it doesn't have a lot of volume. A lot of people don't know about it. I mentioned earlier, this has only been around since September of 2019. And it doesn't have nearly as much assets. So it's not going to be nearly as liquid. This is going to be something you want to buy and basically hold long term. Wisdomtree is a very reputable company, and I'm not worried about Wisdomtree by any means, but just keep in mind that the volume on this is going to be a little bit lower, and it's not well known. So welcome aboard, because I think this is going to help your portfolio outperform even more than it probably already is. Let's look at the holdings. All right. So here are your top 10. You can see, again, equal weighted. So all these started out at 2.5%. They rebalance twice a year. FSLY has outperformed pretty much everything on the list. So FSLY is now the highest weight at 2.84%. Then you got Zoom, which obviously did really well and kind of pulled back. TWLO, which has been on a rampage as well. Everbridge, all these companies have just torn it up. Datadog, Five9, Shopify, Zscaler, Cloudflare, DocuSign. I own every one of these companies except for Everbridge and DocuSign. Another reason I like this ETF is I can get exposure to the couple stragglers that I don't actually own individually. Let's look at all holdings. So as of 5/12, this is of yesterday, and depending on your broker, it might not be accurate. Like in Fidelity, it wasn't updated yet. So the best way when you're looking at ETFs and you want to know exactly what's in it, you want to know the precise percentages, go to the actual fund, in this case, Wisdomtree, go to their website. And in this case, you'll actually have to register and get a login, and then they'll share this information with you. But you can see, so fastly, we already covered the top 10. Shopify, Zscaler, Cloudflare, DocuSign, love it, right? So here we go. OKTA, Coupa Software, CrowdStrike, Viva Systems. Any of these sound familiar? I've got videos that talk pretty much about every one of these stocks. 2U, Team, right? You got Wix, you got RingCentral, PagerDuty, PayPal, Qualsig, AVLR, Slack. A lot of people like Slack. I don't own Slack, but I do through this ETF now. I've got at least a part of it. Smartsheet. This gets the ones that haven't performed quite as well. RealPage, ServiceNow, one of my top holdings. Box Inc., Tenable Holdings, New Relic. I also own that one. Adobe, I own that one. Dropbox. I do not own Box or Dropbox. And it's interesting because I know, Blake, you and I were talking about this, and they actually have started performing really well. And it seems odd to us, but I don't know if I would own either of those stocks individually, but they're in this ETF and they actually are performing well. So sometimes you're wrong and you just have to roll with it. HubSpot, that's on my list to buy. Blackline, I did it. My last video was on Blackline, BL. Proofpoint, another great company. Salesforce, Q2 Holdings, Pluralsight, Appfolio. There you go, Blake. Appfolio, Square, Zendesk, Paycom. I just added some more Paycom today. It was down 8%. Workday has not performed well, but actually I'm surprised to see Workday on there because it's a lot bigger than these other ones, but whatever. Mimecast, Yext. I did a video I mentioned earlier on Yext last year in 2019, and I do think that company has potential. It hasn't done anything for the last year or so. Workava Inc. I actually don't even know what that is, to be honest with you. Paylocity, I own that individually. Medallia Inc. I do not know that one. Domo Inc. I'm not familiar with. J2 Global, know that one. Zora, and Anaplan. So a lot of these in this is back 50, or the back 10 of the 52. A lot of these last ones I don't actually own. I don't own Anaplan or Zora. I've got Paylocity. I had Yext and I sold it. But you got 52 holdings, and almost every stock in here I already own or would like to own. There's only a couple in here that I don't really know very well, and I'm going to dig into those. But you can see absolutely phenomenal holdings. These companies are just absolutely crushing it. And you say, well, they've already made a run, and that's true. And right now the market's pulling back. The Dow is down 2.6% with 30 minutes left in the day. There's a good chance that the market continues to sell off here. If it does, be looking to add this ETF as a way to play those, because I think they will bounce back very quickly. And if you can get this ETF, below $30 and dollar cost in, I think that you'll probably be pretty happy in a couple of years if you're holding this long term. So take a look at this one, guys. I'm telling you, it is my favorite ETF, hands down. Nothing's even close to it. And I added more today. And anytime it dips at all, I'm going to be adding this. I'm probably going to play this ETF as my primary investment moving forward. I have so many individual stocks that are already in here, but instead of buying more of those individual stocks, I'm going to start adding more and more to this and make it one of my core positions next to QQQ and next to the VOO or the VOO. So we're going to see VOO, QQQ, WCLD. I like Sky and ARC, but those are going to be smaller positions than WCLD. One last thing before we go, and I put this at the end because I know the people that are watching are the ones that probably know about Sky and probably even own it in their portfolio. So I want to do this comparison as I wrap it up. So here's a comparison of Sky and WCLD. And you can see the expense ratio I mentioned earlier. It's only 0.45% on WCLD, where it's 0.6% on Sky. So it is a little cheaper, which is great. I did also mention earlier about the liquidity. So if you look at the shares outstanding, it's only 3.25 million shares of WCLD. It's a new ETF. It's from literally the end of 2019. And you can look at the average volume, 157,000 shares traded in 1 month versus 1.3 million on the Sky. If you look at what's, the amount of money invested into it as well, Sky is much, much larger. More people know about Sky. More institutions have money in Sky. WCLD is an up and coming ETF. It's a high risk, high reward type ETF, and it's awesome. So performance. Now, this is gonna really prove my point. Look at the year-to-date return. WCLD is up 25%. This whole pandemic has accelerated these smaller cloud companies. And you think of Sky, you have these more mature companies. You've got the Amazon, the Microsofts. There's stuff that you want to own in your portfolio, but this WCLD is very much it's kind of a accelerated big bang part of growth. So, look at the performance, guys. Year to date, 25. It's new, but year to date is 25% versus 8%. That's some serious performance. And and you like this. So I mentioned earlier that this is complementary, that WCLD is complementary to SKY. It's not meant to replace it. And if you look at the number of holdings, you've got 53 on WCLD. One of them, I think, is cash, 65 on SKY. And then this is really cool. So look at the holdings. Look at how much different. Yes, there's some overlap. So you might have a couple of stocks that are owned in both. But for example, SKY has Cisco. Cisco is not a growth company. It's in there. And SKY is actually paying you a decent yield too. So keep that in mind. WCLD is not paying you any dividend. SKY is paying you a little bit of dividend. They're very, very different. But, Amazon's a top holding versus FSLY. I mean, completely different, in size of the company and what they do. VMware is number 2 versus Zoom. Oracle and Microsoft versus TWLO and Evergreen. I mean, it's a completely different type of ETF. Centurylink, which I don't love, is in here. You'll see Shopify on both. You see Shopify is 2.97% of the SKY ETF, and it's 2.5% of WCLD. I don't think if I own just two ETFs and 5% of my money was in Shopify, I'm not going to be upset about that. So there is some overlap, but for the most part, that's all you're really going to see is on this page, I think, unless I'm missing something, is just Shopify. Let's go to page 2. Splunk is on here. I don't even think Splunk is in this WCLD. You got Adobe in both of them. You got Adobe down here at 1.74 versus 1.96. I mean, there are some overlaps, but this also has fintech. You've got PayPal in WCLD. I mean, that's awesome. Domo, it looks like, is in both, because I remember seeing that. Cloudera is in one. I don't remember seeing it in the other. Blackline, I think, is in both, small amounts. New Relic's in both. So this very different makeup. So, and remember that WCLD is equal weighted, where the SKY is not equal weighted. It's going to have, it's going to look at the different weights. Amazon's, 4.6%, and you've got, these tiny holdings like 0.46%. This is equal weighted on the WCLD, and it's going to be, twice a year, they're basically going to sell and they're going to rebalance. So, lowest you're going to see is 1.27% on Anaplan versus Eventbrite is 0.34%. They're completely different ETFs in terms of really what's in them, their goals, their performance, everything. And I wanted to do this quick comparison for you. Thanks for watching, guys. I really appreciate your time and attention. If you haven't subscribed, I'd really appreciate it if you click on the bottom right-hand corner, hit the subscribe button. There's a little bell you have to click to get notifications. It's really important. So when a new video launches, you get to get a notification and go right to the video. If you haven't checked out the Facebook group, we do have about 2,000 people on there, and it's growing quickly. Just go to Facebook, type in Fired Up Wealth. There's a public page, but there's also a private group. And we do a lot of conversations and Q&A and dialogue on there, and it's a lot of fun. Again, I appreciate your time. Appreciate you watching this. I know it's 30 minutes, but it was really fun to make, and I'm super excited about this ETF, and I wanted to bring it to you as soon as I possibly could. So thanks again for watching. Have a great rest of your day. Take care.